Something happened in the silver market that most people still don't understand. And the strangest part isn't the crash itself. Crashes happen. They're loud, violent, and emotional. The strange part is what happened at the exact same time the market was collapsing. While silver prices were imploding on Western exchanges, while traders were getting liquidated, while headlines were declaring the end of precious metals, a completely different story was playing out somewhere else. A story that never made the front page. A story that doesn't fit the narrative you were told. And once you see it, you can't unsee it. Let's rewind for a moment. In just over a year, silver went on one of the most aggressive rallies in modern financial history, from roughly $30 to well over $100 an ounce. A move so fast, so relentless, that it pulled in everyone. Retail traders, hedge funds, momentum algorithms, speculators who had never owned an ounce of silver in their lives. Gold was doing the same thing, pushing to record highs, breaking level after level that had once been considered impossible. The explanation was simple and convincing. Central banks were buying. The dollar was weakening. Inflation wasn't going away. Industrial demand was exploding. Everything made sense. But markets don't move in straight lines forever. And when too many people pile into the same trade at the same time, the exit door gets very small, very fast. By late January, silver wasn't trading on fundamentals anymore. It was trading on momentum and leverage. Prices were jumping several percent overnight. Every dip was bought instantly. Every pullback lasted minutes. Then, on a single day, the tone changed. A shift in monetary expectations, a stronger dollar, a signal that rates might stay higher than people hoped. But that was all it took. The selling started quietly at first. Then it accelerated. Margin calls began firing across trading desks. Positions that had been built with borrowed money were suddenly underwater. And once forced selling begins, it doesn't care about logic. It doesn't care about supply deficits. It doesn't care about long-term demand. It sells because it has to. Silver didn't fall. It collapsed. Prices that had taken months to build were erased in hours. Stops were hit. Accounts were wiped out. Liquidity vanished. By the time most people realized what was happening, the damage was already done. And that's where most analysis stops. You've seen those videos. They explain the leverage. They explain the margin hikes. They explain the psychology of panic. Then they move on. But that's not where the real story ends. That's where it starts. Because while Western markets were in free fall, something extraordinary was happening elsewhere. At the exact same moment silver was trading in the 70s on U.S. exchanges, the price of physical silver in Asia told a completely different story. Not slightly different, radically different. The same metal, same atomic structure, same industrial use, same periodic table element, but priced nearly 30% higher. Let that sink in. While traders in New York and London were dumping contracts at fire sale prices, buyers in Asia were calmly paying a massive premium to secure real, deliverable silver. They weren't panicking. They weren't selling. They were accumulating, and not quietly. That price gap didn't appear overnight. It had been widening for months, growing larger week after week, month after month. Over the past year alone, the difference between Western paper prices and Asian physical prices exploded by more than 1,800%. That's not a glitch. That's not noise. That's a market screaming that something is broken. Because in a functioning global market, arbitrage closes gaps like that instantly. Buy cheap here, sell higher there. Prices converge. But that didn't happen. Why? Because one side of this market trades promises and the other trades metal. On Western exchanges, most silver never changes hands physically. Contracts are opened and closed, rolled forward, netted out. Delivery is rare. In Asia, delivery is the point. And during the crash, the physical market didn't blink. In fact, it did something even more revealing. While Western silver was collapsing, Asian futures markets hit their downside limits almost immediately. Trading froze. Contracts locked. Prices couldn't fall any further, even if traders wanted them to. And here's the part almost nobody talks about. Those limit-down prices, when converted into dollars, were still dramatically higher than what silver was trading for in the West. In other words, Asia's worst-case scenario price was still well above Western market prices. Their floor was higher than our ceiling. That alone should make you pause. But it doesn't stop there. Authorities stepped in aggressively. Funds were suspended from trading. Position limits were slashed. Accounts were restricted. Not to stop selling, to stop excessive buying. Think about that. During one of the worst silver crashes in decades, regulators weren't trying to prevent panic. They were trying to cool demand. At the same time, silver found a floor. Not at 0, not at 50, not at 40, but in the low 70s, and it bounced hard. That bounce wasn't random. It wasn't hope. It wasn't retail traders trying to catch a falling knife. It was industrial demand. Factories don't care about charts. They don't care about technical indicators. They care about supply. Solar manufacturers can't turn off production because silver is volatile. Electronics companies can't pause assembly lines because futures traders got liquidated. Silver is a tiny fraction of their total cost, but without it, production stops entirely. That demand doesn't disappear in a crash, it waits. And when prices fall far enough, it steps in. That's what happened at 72. Now here's where the story gets even more interesting. Just days after this historic crash, the United States government announced an emergency level meeting focused on critical minerals. Not inflation, not employment, not interest rates, critical minerals. International delegations were flown in. Supply chains were discussed, strategic vulnerabilities were addressed, and silver sits right at the center of that conversation. Because silver isn't a luxury metal anymore, it's infrastructure. It's inside solar panels, electric vehicles, data centers, semiconductors, medical equipment, satellites, defense systems. Modern technology doesn't function without it. And here's the uncomfortable truth policymakers are finally confronting. The world consumes far more silver than it produces, year after year. Industrial demand alone accounts for the majority of usage. That silver is consumed, not recycled efficiently, not returned to vaults, gone. For years, the gap has been filled by drawing down existing stockpiles. Those stockpiles are shrinking, and new supply isn't coming quickly. Most silver isn't mined directly. It's a byproduct of other metals. You can't just decide to mine more silver. Even if prices doubled tomorrow, meaningful new supply wouldn't arrive for a decade. That's the structural problem, and governments know it. Which brings us to another quiet but critical move. One of the largest precious metals trading operations in the world recently shifted its focus to Asia. Not expanded, relocated. People don't move billion-dollar operations across the globe on a whim. They do it because the center of gravity has shifted. Because that's where physical demand lives. That's where premiums are paid. That's where the real market is forming. Put all of this together, and the picture becomes clear. The crash didn't destroy silver, it exposed the divide. Two markets, two prices, two realities. On one side, a highly leveraged paper market driven by speed, algorithms, and margin requirements. On the other, a physical market driven by necessity, strategy, and long-term planning. When pressure hit, the paper market snapped. The physical market absorbed it. And here's the part that matters most. Wealth doesn't vanish in crashes. It moves. From emotional hands to prepared ones. From leveraged speculation to patient accumulation. While screens were red, someone else was buying calmly, deliberately at a premium. Not because they thought prices would bounce tomorrow, but because they need the metal for the next 10, 20, 30 years. This isn't the end of silver, it's a transition, a shakeout. Speculation was washed out violently, excess leverage was destroyed, but the underlying story didn't change. If anything, it became clearer. The real question isn't whether silver is dead, it's which silver you're talking about. The paper version that collapsed under leverage, or the physical metal that governments, industries, and strategic buyers are quietly competing for. Those are no longer the same market, and once that separation becomes obvious to everyone, the repricing won't be subtle. History is full of moments like this, periods where volatility convinces people the story's over, right before the next chapter begins. The crash wasn't random, it wasn't meaningless, it was a stress test. And it revealed who was forced to sell and who was prepared to buy. That's the hidden economy most people never see. And now that you've seen it, the silver market will never look the same again.